I'm Gino Rossi, the portfolio manager for the Spheria Global Microcap Fund. And today I want to talk to you about markets broadly and why we think they're not quite normal. You could say they are different this time, but that a return to normality is inevitable and what to expect when that comes, and why perhaps it's a good idea to position ahead of time rather than waiting for the party to end. So let me start with just a very basic observation, which is Apple. I mean, we're told that this is the most efficient market, and that it's so efficient, in fact, that you should just put your money in passive, and that your average US fund manager really struggles to add value. But at the same time, look at Apple, which is a multi-trillion-dollar company, perhaps the most invested in, covered, talked about company, and yet it was trading at 73% below the current share price as little as early 2019. That does not smack at efficiency to me. And I think, like many, we would point the finger at central banks and the fact that the rules have changed post the GFC. And so you can see here analysis from Bank of America that shows before GFC, earnings used to explain nearly half of the S&P's returns. But since the GFC, actually the bigger factor is the Fed balance sheet. And then if you look at analysis from Citigroup, we think they do an even more eloquent job. And here they add up the major central banks' balance sheets around the world and call it global bank reserves. And you can see a very tight correlation between central bank balance sheets and the MSCI world. What's interesting too is that a lot of this liquidity is entering through passive. We know that, but you can actually see the fingerprints of that in the market. So during COVID, when the Fed really went hard on the printer and expanded its balance sheet by nearly $4 trillion US, what you witness during that time is an enormous difference between the S&P equal weighted and market cap weighted index. So clearly an enormous distortion from all this wave of liquidity as it goes into passive index funds. To the point that the difference between the S&P equal and market cap weighted was almost equivalent to the Fed's balance sheet expansion. We're not saying that's causation, but it clearly shows an enormous impact on the market and a distortion on the market. And because of this wave of liquidity going to larger stocks through passive, the overall metrics for the market are not looking attractive. The Buffett indicator, which has been shown to be a pretty good indicator of future returns, is screaming very high, and that you can't expect much from the market going forward. And from our point of view, we notice that large caps are now looking very stretched relative to smaller companies. Large caps always trade at a premium, but with all that liquidity going into large, that premium has really stretched out. You can see that versus the world micro, the S&P is trading on a premium of 50 times on our preferred measure of EV to earnings before interest and tax. And I don't think it's a secret that there's very little value in large caps at the moment. It's hard to construct a good portfolio at a cheap price. However, in micro, where you're further away from this wave of liquidity, you can see that we can construct a portfolio 15 times EV to EBIT that has superior growth. And I should say that's just a one-year number, so please don't extrapolate that out or think it's always that fast. Better free cash flow yield, better dividend yield, stronger balance sheet. So we have negative net debt, meaning the portfolio has net cash. And then that final column there is the cash conversion, which speaks to our process where we like to see the profit and loss converted into cold hard cash as cash profit. And that's often a differentiator between smaller companies and large cap companies, and hence why our process is so focused on it. So you can see that because we're further away from this wave of liquidity, we can construct a very good portfolio, actually a better portfolio, at a fraction of the valuation. So that central bank funnies, little doubt, is creating an enormous distortion but the majority of that liquidity is going to large caps, and that's where you're going to find the biggest problems, which is probably going to be evident in hindsight only. But when free markets return, we think, we think a few things are going to happen. Firstly, I think .com is quite a good analogy. If you think GFC or you think COVID, that was very much an economic impact. But if you think .com, there was a very mild recession in the early 2000s. It was more about just heat coming out of the market, valuations and fear and greed. And under that scenario, you saw smaller companies outperform quite a lot. Here I show the MSCI small cap. You saw it go down much less than the S&P or the NASDAQ, and then rip out much faster when the market found its feet. We don't have an MSCI micro cap that goes back that far. We don't have a Russell micro that goes back that far. We do have a Wilshire micro, and that outperformed the S&P by 3% on the way down. And again, for those of you that were around, you remember, there was a real malice, and it took a long time for the economy to get some traction and start growing at a reasonable pace again. But as soon as that became evident to the market around the middle of 2003, microcaps absolutely tore up. And that is what they typically do. They will often go down pretty much with larger companies, but then they will be the first to bounce out. So we think, if you do see a sort of .com scenario where just heat comes out of the market and valuations are brought into question, which you're starting to see signs of now, that smaller companies could be actually a very good place to be relative to these mega caps. When free markets return, you should see a re-establishment of the micro-cap premium. Large caps have done very well versus small companies because of that liquidity wave. But over the long run, micro-caps earning a premium of 3% in the US and 6% in the UK. We think that'll return once the QE funnies end. And alpha is going to matter more because you can't expect markets to go up 20, 25%. Sorry to be the bearer of bad news. I wish they did too, but they're not. An equity return is mid to high single digits. It's your risk premium over your risk-free rate. So in the context of a 7 or 8% return in a more normal market, an alpha of 3, 4, 5% is a big deal. And we think people have not been focused on alpha because the beta's been so good. But going forward, I don't think it's going to be that way any longer. And so if you want alpha, where you're going to go? Well, you look at microcaps, you can see they're very undercovered. It's a huge universe. The average microcap only has 32 institutions on the register compared to the S&P with over 1,500. So, this is the place to get alpha. Now, so we're saying when free markets return, you should see that market cap premium. Alpha is going to matter more. But there's an argument to say, well, let's position for it now. Let's not wait for the party to end. So you can see in this chart that because this wave of liquidity going to passive, large caps has actually outperformed small and micro since our fund's inception, which is just shy of 3 years. But we've been able to do better than all the indices. So by being in micros, you're not losing out on any returns. In fact, you've been getting better returns. What about risk? Well, much depends on how the manager manages the money. We are fundamental, bottom up, we're not thematic or macro. So our risk metrics are very good. And you can see our volatility compared to the MSCI one is comparable on a monthly or quarterly basis. Much longer on a daily or weekly, but I think most people focus on that monthly number. So you're not taking additional risk. Liquidity average stock is about Aussie 1 billion, US 700 million. And as I said, our balance sheet's a net cash in the portfolio. But the real kicker is that because of passive, you've really had a crowding out of managers where most managers at the moment are holding very similar stocks, and so they're highly correlated. I mean, our analysis shows a very high correlation between many of the most popular large cap managers out there. Whereas global micros give you great diversification because they're not holding the same stocks. Because microcaps do have their own distinct cycle, and because the US is not such a feature. In large caps, 69% of the index is US. And if you've been outperforming and winning money, you've probably got more than that because the US has been so strong. In microcaps, the US is only 24% of the index. So it gets you away from the US, it gets you in different stocks, and it gives you much better diversification than having 2 or 3 large cap managers, which at the end of the day are all owning Meta and Apple and Google. Because of that diversification benefit of micro and because of the way we manage money in a very conservative manner, you can see our downside capture against the microcap index, or in this case against the MSCI World Index, is very, very good, and I'm very proud of that. So you're not going to get these big drawdowns that you think you might from microcaps. Quite the opposite. The fund does very well when the MSCI World is going down. Very quickly, because time is an issue, I want to talk about a few stocks just to give you a bit of colour around the type of companies we're investing in. So firstly is Concentric. I spoke about the size of the businesses. We are micro in a global context, but this company is US 1.1 billion. We probably bought it when it was about US 600 million. It's done quite well for us. Concentric are a maker of pumps and hydraulics, which doesn't sound that exciting, but because of ever increasing or more higher emission standards, OEMs of trucks are having to shave off efficiency wherever they can find. And that means that Concentric are not making homogeneous basic pumps. They're having to make very efficient fuel pumps so that these OEMs can meet the emission standards. And thus far, that's resulted in very good cash flow, good returns, all things we're looking for, and a differentiated product. But going forward, you've actually got a play on electrification that's not as well known around the market, because as these emission standards go up, you're having to transition to e-pumps. So rather than the pump being driven off a belt, you're going to need an e-pump that can turn itself off. And then longer term, if the drivetrain is electric, you're going to need more pumps than you do for a combustion engine. So you can see how these regulatory changes on emissions is an excellent structural tailwind for this business, which is a very strong industrial producing good cash flow with good valuation support. We're not buying something that rolls trucks down hills. We're not buying something that is going to make a great EV. We're buying a very good business today that's giving us a return today, but has a bright future as well because of this structural talent. Fashionette is German. It is a leading e-tailer of fashion accessories, higher end fashion accessories in Germany, Austria and Switzerland. What's interesting about this is where Concentric is a structural grower. This is more a contrarian play, listed, and despite its very strong position in those markets and good structural growth, it had a mishap where it changed logistics providers and disappointed the market, and it's in the sin bin. So this is where we come back to valuation and doing your fundamental analysis. We can look at this and go, well, actually the risk reward here is very favourable, because the market has discounted this thing. They're not expecting much, but you've actually got a leader in a high growth industry with a very good balance sheet that's made a good acquisition already. And so we see a lot of upside here and we're not having to pay for it. And then finally OTC. OTC you may know because they own the pink slip market in the US. So these are penny dreadfuls that trade on the pink slip, but OTC also has a medium and a higher tier of exchange, such that companies like Rossi and Heineken and Adidas are listed there already. In fact, our very own Fortescue is listed on the OTC in the US. And companies like to list on the OTC because it is cheaper to list and because the filings, you do not have to refile for their market. You can basically file what you've already filed in your overseas market. But we think this company is at an inflection point because recent regulatory changes mean it's much easier for OTC to onboard new stocks, and it's also easier for brokers to onboard clients and trade on the exchange. And then you should see more liquidity, which attracts more listings, and you can see a virtuous circle up. Only covered by 2 brokers. To buy the stock, you have to actually buy it on the OTC exchange. Very much under the radar. I think a market cap of about US 700 million. But a great business, and we don't think the market is aware of the upside and the positive effect these regulatory changes will have on the earnings in future years. So that gives you a sense of the sort of companies that we are finding that you won't hear about anywhere else, but we think will do very well for our clients. So if I can summarise, it's not different this time. The most dangerous words in finance is to say it's different this time. But we think when free markets return you from wave to beta, alpha is going to matter a lot more. And and we think there's going to be a trend away from passive, and where you're going to get your alpha, well, we think we're best placed to deliver alpha in this sort of market. When you go back to free markets, that market cap premium will re-establish itself. So you should see a premium from investing in micro caps. And as I said, more alpha. In the interim, we think you're not losing anything by being there now. The returns have still been ahead of the large caps despite all the wave of liquidity into large caps. On a standalone basis, they're not really riskier than large caps because of the way we manage the money. But we think the low correlation is really underappreciated by investors. We think your clients will be very well served by adding this to a portfolio. It will lower your overall portfolio volatility and has performed exceptionally well in drawdowns, be it COVID, tariff wars, or the January sort of tech sell-off. So please consider it. I love talking about this fund. I'm very passionate about it, and so would love to hear any questions or comments. So please feel free to come through to Pinnacle, and thanks for your time.